Hi there, I'm David, and today we're going to talk about modern monetary theory. However, before I start, here's a small disclaimer. The views and opinions that I share during this video may not be the views and opinions of GeeklyEDU. Alright, with that out of the way, let's get started. So, modern monetary theory has been making the courses a lot in modern media and has been discussed a lot on the internet. But what is it? How does it function? I think the best way to understand this is to first understand how things work right now. Now, there are two types of spending in an economy. There's unproductive and there's productive. Government spending is technically unproductive as it does not necessarily contribute to the economy itself. Consumers are the productive source of economic value. So a government would spend money to its workers, its contractors, its employees, staff, etc. Those individuals put their money in the banks, and the banks, with their control over percentages of money that they distribute through loans, then give back into the population at large or the consumer base. So our productive economy here is our major population. The money then gets taxed and goes back to the government. There are different ways that a government can spend money. The first source is taxes. The second source is the existing bond market. So imagine you go buy a bond. It's essentially a promise that later you can sell it back to the government and get your money back, even with interest in some cases. And there's also that the Federal Reserve can print more money and buys bonds that the government issued, which then means more money into the government. So that's kind of an interesting check and balance there, that the Federal Reserve is printing money and then buying bonds that the government issues instead of straight distributing it into the economy. So that means that the government also has some control over the issuance of bonds and the distribution of money. Well, there are two things in regards to the distribution of money. There is the money that's in circulation, and there's also the velocity, or the spending that is done in regards for goods and services within the economy at large. Now, macroeconomics isn't really that complicated, to be honest with you. It can be seen that way at first, but if you deep dive into it, it's just a few components that pile together. But let's get a little bit further in here about controlling inflation. So imagine the Federal Reserve wants to decrease inflation. So there are two methods in which the Federal Reserve can control inflation. The first of which is that it can sell the bonds that it already holds, or it can increase the percentage or the interest rates on the money that it gives out. So banks then would be less likely to distribute loans if the percentage rates or the interest rates are higher. Inversely, if you want to increase inflation, the Federal Reserve can then lower interest rates or buy bonds, which then distributes more money into circulation. Now, when it comes to the circulation of money, velocity, or the money being spent in a certain speed, if you will, for goods and services, if these two things, if circulation goes out of control, well, you end up with inflation. However, if the amount of money that is in circulation increases, but velocity also increases with it, such as goods and services, as I said before, then inflation will remain stable, more or less. And more or less in theory, if you will. So there are different circumstances historically where these things have contradicted themselves, but in general terms, that is how things work. But if velocity decreases and the amount of money in circulation remains the same, then you end up with inflation because there's more money out there than really is being used. So now that we understand how things work today, well, we can then talk about our situation with modern monetary theory. So the way that things work today, the government can borrow money from the bonds, and the Federal Reserve plays a big hand. However, when it comes to modern monetary theory, we are saying goodbye to all of this. Of course, we'll keep our circulation here, but don't worry about that. All right, so what are the modes to control inflation in such a situation here? Well, taxation. So if inflation is going up, then the government taxes the population more. This means that there would be a higher tax rate for everybody involved until the amount of money in circulation is reduced to meet velocity. However, this is assuming one thing, that the people will be accepting of taxes randomly going up and down willy-nilly. And if you've ever noticed something, typically when taxes go up, they stay up for a very long time. And the debate rages on for quite some time until a new administration comes in and they do actually fulfill that promise to reduce taxes, which can be upwards of 12 years, for example. So imagine you increase your rate of taxing, but it doesn't go down when the amount of currency in circulation is reduced. That could be a problem. Well, what else do we have to say about this? There's something called the job guarantee in regards to modern monetary theory, where those that are unable to work, such as those who are mentally unfit, unstable, have a substance abuse problem, or people that are just down on their luck. Maybe they worked at a factory that shut down because of some situation. Well, the government in this case would then be able to hire them optionally, but this leaves a very dangerous door open, which I'll mention in a moment. So these individuals would have the option to work for the government to build bridges, work on infrastructure, do social services, etc. But the danger of this optionality of utilizing human capital is that later it could become mandatory. As with all things where they seem good on paper and innocent in their own way, people have a tendency to overcomplicate situations. And this is all coming down to another point of the government who is providing these services of these individuals who were unable to work being as efficient as the private sector. And if you've noticed history as a trend, governments are typically very inefficient. It's just because of bureaucracy. There are too many people with different opinions. If you've ever been at a business meeting, there's always another guy with another wonderful opinion about how you can expand the company. But typically speaking, it's not within the scope of that company at hand. So when it comes to this efficiency problem, there's also another situation that can arise. You are now paying the very liberal rate of $15 an hour, for example, for these people to be working on building a bridge, and you have increased the amount of jobs that are available through this job guarantee program. Well, how do you get them to quit their job to go back into the private sector? It's easy to scale up, but it's not so easy to scale down. There are a lot of questions, concerns, and problems that can arise from implementing such a system and removing our checks and balances, such as the Federal Reserve and the bond market. Mind you, I'm not necessarily a fan of the system of fractional reserve banking or the Federal Reserve as well. Because, as history can note, the Industrial Revolution was a period of 77 years without a central banking infrastructure. Instead, states were able to choose a bank that they wanted to do business with primarily, and that was how things were for a very long time. After the War of 1812, Congress attempted to return the central banking infrastructure that had been in place prior to the War of 1812 that had expired, and the president at the time ended up vetoing it, saying absolutely no way. For 77 years, there was no central banking infrastructure, and all of a sudden, the Industrial Revolution took over the nation by storm, and we experienced one of the most prosperous times in our history, even as a planet, a species, not just as a nation. But the other countries that partook in the Industrial Revolution did also face very similar positive rewards during that time, but none as much as the US. So, there are a lot of questions, theories, possibilities, and potentials for various situations and solutions. Like I said, I'm not necessarily a fan of the Federal Reserve itself, but modern monetary theory seems like a very dangerous path that we could go down. There are so many different things that we could discuss in regards to this. However, I will leave it there, and I wish you all a beautiful day. So, thank you very much for watching. Don't forget to subscribe, check out other videos, like, share, comment, hit that bell for notifications, and we'll see you next time.